Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for March 7th of 2022. Please see our disclaimer for important information. Here's our weekly high-frequency data, courtesy of First Trust, our friends up in Chicago. Weekly data has softened up a little bit, particularly in consumer discretionary areas. So you see TSA checkpoint data a little bit off, open table restaurant data slightly off, although hotel occupancy has been trending quite well in recent terms. You look at the month over month, and most of those areas are actually positive. Now, we have seen some production curtailments. You see the rail car traffic, steel production off both the week and the month. We do know that production activity has been a little bit soft. Demand, I think, a little bit softer than it has been. I think some of it has to do with high prices. Obviously, there are some uncertainties with regard to geopolitical activity. But by and large, the data, as you look at it over a month-over-month basis, is pretty good. We haven't set any new highs. Obviously, we had a pretty strong February labor report. And as you can see, the change relative to 2019, basically pre-pandemic, that we're starting to really narrow that gap. So TSA checkpoint data only roughly about 10% below where we were. And then restaurant industry activity, hotel occupancy, really only down about roughly 3 to 4%. This is kind of a bullish, bearish sentiment indicator for advisors, actually. So, and you look at this. I mean, there's a significant bear feeling here. You see, the top is the S&P 500. When it rolls over, you can typically see that sentiment goes down, which is kind of ironic because it's really symptomatic of a behavioral bias problem. That when the market goes down, advisors get a lot bearish when they should be looking for opportunities, frankly. And so I tend to think of the market as being a bit oversold, and there's some things which we'll look at here in a second, which will seem to corroborate that. I mean, obviously, we're not without risk, and there are some things that have yet to be concluded, namely whether we're going to get 25 basis points of interest rate increase here in another week to 10 days. Or if it's going to be 50 basis points, how long does this war drag on? Does it bleed over beyond Ukraine? I mean, these are things that we kind of don't know at this point. But I do think the market's been oversold, but you can see here advisor sentiment is very weak. So, usually what this tells us is that advisors are raising a lot of cash at this point and are typically a little bit late to the party to reinvest it. And so, we have put some of our equity cash actually to work now in some longer dated kind of structured notes, which give us leverage to the upside when the market does go back up again. But you can see here advisor sentiment is actually somewhat pretty weak right now. Here's some information from BKA Research, bank credit analyst. They're up in Montreal, and again, on the upper part of this chart, you see the S&P 500, and then down below you see the Fed funds rate. And so what this tells us, we have, a fair amount, by BCA's estimation, a fair amount of capitulation in the market, meaning that the market is oversold. And their trend indicator, which is in that middle area, and this might be a little hard to kind of reason because you really have three different things going on in this chart, but that number dipping below closer to that first really standard deviation, if you will, just indicates that we're probably oversold. But I think the risk factor here is what happens with the Fed and obviously with interest rates. Here's an interesting chart I came across. Obviously, a lot has happened in the last 2 weeks, and we're hearing a considerable amount of turmoil and anxiety with regard to Ukraine, and hearing the plight of the Ukrainians. It's very sad to hear. But what it has done is it's really changed the calculus on a dime, in fact. Just as at the beginning of February, we were really focusing on inflation and the need to kind of accelerate some of these rate increases to respond to that. because the data was just, it seemed at that point to be extremely confirming. You could see the 25 basis point hike probability, which is in that blue, peak at the beginning of February and then drop like a rock. And then consequently, the 50 basis point hike probability, in other words, a half percentage point, that probability spiked. And these two probability trends completely reverse themselves. Well, guess what? It's done it again. So now the market is much less on the expectation for a 50 basis point increase, and much more likely that a 25 basis points or quarter of a percentage point hike happens when the Fed does raise interest rates. And the other thing which related to Fed interest rate increases, and it's funny how quickly all of this can change, right? And so you saw on that last chart just how quickly that probability switched from a huge rate increase to something that's a little bit more benign because of what was going on with the Ukrainian war and kind of the uncertainties regarding future consumption and things like that might be derived off of that. And here, may be a little tough to read, but what it essentially tells us is that literally in the last week to 10 days, we've gone from a strong feeling of maybe having as many as 7 rate increases to only having 5. And it just goes to show you again that these things do change quickly, and they can still change again depending on the pace and how this campaign is prosecuted by the Russians in Ukraine. So we'll just have to keep our eye on it. Here is the PE ratio for the S&P 500 index, and I think also important is the equal weighted index. So let's back up a second. So the S&P 500 is a capitalization weighted index. So firms like Apple that have a massive capitalization, market capitalization, they tend to dominate the S&P 500. And frankly, I can tell you that there's a lot of technology stocks that tend to have outsized influence on the S&P 500 index. But if you took all roughly 500 constituents and then made them all equal contributors, that's where you get that equal weighted index. And you can see the price to earnings ratio is a lot lower. If you look at the index as a whole, right now the multiples have dropped in a good way, I think, and we've talked about this, from like 23 to 19. Well, if you look at the equal weight, it's actually dropped all the way to 16, which is extremely close to long-term trends. So, I still think that there are some higher multiple stocks within the index that probably have room to come down. But if you look at the index as a whole, it's actually not terribly expensive right now. And this really just kind of confirms what we saw in that last chart. The pace of which these multiples have come down has actually been pretty impressive. So in the last chart, we just saw the aggregate multiple on kind of a real-time day-to-day basis. What this shows us is the change over rolling 40-day periods in the market. So this is a very kind of smooth trend line, if you will, and you can see that it oscillates around 0, which means that over 40 days it's apt to move slightly higher or lower. Maybe over time it trends, but this kind of mutes that out. And what we've seen here is something that is rather dramatic, actually. And you look at where we've dropped in just this rolling 40-day period. Excuse me. You have to go back to Lehman Brothers. You've got, the 2003, tech bubble capitulation. You've got COVID-19 shutdowns, Fed rate concerns in 2018 to see how unique this recent trend has been. We usually just don't see price to earnings multiples move this quickly, this soon, but it certainly has in this case. Here's something that might interest some of you. So, and I may have shown this last week. Actually, I didn't look at the notes to see if I did, but I think it's important to realize that, if you look at military conflicts and the disruptive nature that they have on markets, it's generally near term. But if you look at essentially 1 to 3 months after the conflict, it's extremely rare to not have the market move higher. And I think this conflict is just added to this uncertainty that pervades the market right now that's sitting on the precipice of this first rate increase. Those two things, I think, have prompted a lot of selling, cash raising. So we saw advisor sentiment has kind of rolled over a bit, and I think that's obviously in these numbers and in the price to earning multiples coming down so quickly. But I think it's also worth noting here that when you get past a conflict, that the markets tend to act a lot better. And on this chart, we're actually looking at hedge and other kind of high information traders. I'll call them institutional traders that are taking a bet on equities. And so what this shows you is that that they're taking a higher bet on equities than that we've seen in quite some time, which is good from a speculative standpoint, even if traditional advisors are a bit negative. Here is a quick chart, just again highlighting growth versus value. We've talked about this. There have been times where the cyclical trade has worked. Right now, defensives are outperforming at a time of kind of this heightened uncertainty. But it's really clear here too that growth is still overvalued relative to value. You can see that in this chart. Again, this is also from Bank Credit Analyst BKA up in Montreal. And you can also see down on the bottom side that growth versus value, that we're in an oversold territory right now at a time where growth is still overvalued relative to value, or excuse me, growth is overvalued relative to the value style. Well, here's a quick look at economic data. This is the Institute for Supply Management Purchasing Managers Index, so ISM PMI, but for services. So we also have one of these for manufacturing. This one is for services, which actually for our purposes is a bit more meaningful because services dominate the economy much more so than manufacturing does. But you can see here that activity has slowed. And, we've been watching this play out here for about the last month and a half, really, and it's manifested in the data. So I don't know that we should watch it. Obviously, we care about it. You can see, these two data series on the left-hand side, business activity, and then the PMI index itself is still above 50. It's not above 60, which is exceptionally strong. It has been over 60 for much of 2021, but it's still very much in expansion territory. And even on business activity below that, you can see that where we are is in kind of a rough line of best fit that we've been in since 2015. Not to say that the direction and the precipitous fall here is not worth noting, because it is. It's just that let's not get too carried away yet, because we're still in expansion mode. We're just not expanding as fast as we have. And so, some could characterize that as a quote unquote slowdown, but I just call it a deceleration of what we're looking at. On the right-hand side breaks down the components, and you can see here that clearly the most influential part of that, employment, is certainly there, but also business activity has slowed down and become less of a contributor here as of late. And we'll continue our deep dive into ISM, so just kind of bringing us up to speed here. And this is a national survey, so this is not one of the regional surveys. I know we looked at the Kansas City Fed regional data last week. New orders. We know that new orders have slowed a little bit. Consumption, inflation, there's a lot that's going into this right now. Again, if you look at this being a diffusion index, that it's just not accelerating at the pace that it was, but it's not outsized relative to the historical construct. Supplier deliveries are still longer, but they have come in a little bit, so they've kind of broken the recent trend, although they're still high relative to historical standards. Inventory sentiment has moved higher, so the good news is with order flow decelerating here, that the sentiment on being able to supply inventory or be able to have inventory on hand to support the demand that is coming, there's a lot more confidence there, meaning the supply chain choke points are kind of working their way through a little bit, and that's a good thing. Now, the one thing that's still high, and it may be cresting, so I'll have to watch directionally where it goes here over the next several months, is prices paid. We know that prices have been high. We'll see a lot of things related to the commodity basket here in the coming slides that I think will probably reaffirm the notion that prices are going to remain high for a while, particularly on the production side. Well, one thing before we get into some of the commodity charts is look at our government yield. And anytime you have a global geopolitical event like we've had, there's a flight to safety. And certainly, when that happens, the US dollar and dollar denominated assets usually catch a bid. And that's exactly what's happened here. So prices have gone up as demand has increased, which consequently drives yields lower. And we know that there is an expectation for the short end of the curve, of the yield curve, short-term interest rates to move higher because we know the Fed is trying to fight inflation, right? So short-term rates are moving higher. At the same time here, you can see that arrow on the left-hand chart that 10-year yields have been driven down because of this flight to quality. And so what has happened is that the spread, the difference in rates between the two-year Treasury and the 10-year Treasury have continued to drop. In this case, they're down, closer to about 30 basis points or 0.3%. And, when you get below zero, that means a curve is inverted. That means that essentially your longer term rates are short or less than your shorter term rates, and that inversion oftentimes portends some type of recessionary environment. But these are being rates now, as you can see here, basically a tenth of a percentage point in basically a week with the Russian invasion. And so, we're going to watch this. It's not inverting because there's a real precipitous view of a recession. It's just that there's so much impetus on the front end that's already been priced into the market regarding these interest rate increases that, we haven't really seen that manifest itself in the long end of the curve yet. And then obviously they're getting kind of pushed down because of Russia and Ukraine. A couple of charts I thought were interesting on labor. So wage growth for job switchers, really interesting stuff here from Sober Look on the Daily Shot, that people that are switching jobs, you can see from 2021 on, basically the beginning of last year, that wage growth for people that have decided to switch jobs has been exceptionally strong and very unusually strong, and that's why the quit rate is at an all-time high. You just see a lot of labor mobility, and particularly in the service sectors, but not exclusively in service. But and there's a reason for that. There's a socio-economic reason. There's kind of more of a kind of a social type reason as well. But another reason, obviously, is because with higher inflation, you have low and negative real wage growth. And you can see that on the right-hand side, that when you get into, most of the cohorts, with exception of the low there, that, we've seen negative real wage growth. And that, what does that mean? That just means that you're taking wage growth in the aggregate and you're subtracting inflation from it. And we know inflation's been pretty high, so that's been an anchor on real wage growth. And until we get lower inflation, this is going to continue to be an issue. And I think particularly in some of these cohorts, population cohorts, that it's going to continue to drive a lot of labor mobility and these job switchers looking for higher incomes. Commercial properties. Haven't spent a lot of time on the commercial side of things. We've spent a lot of time on the residential, and really nothing's changed there. But on the commercial side, what I thought was exceptionally interesting was the rate of growth that we're seeing in commercial property prices. We're also seeing changes in cap rates based on the prospect of higher interest rates. And basically this is the rate of rents and operating income over the value of the property, and you use kind of the inverse of that as a multiplier for property values. And we have seen changes in cap rates, and we've certainly seen prices move higher, whether they be in major markets or non-major markets. In fact, non-major markets have gone up at a faster rate than some of these other areas. And you can see that it's not limited to one particular category, that whether you're talking about multifamily, retail, industrial, office, even office has gone up here quite a bit in 2022. We'll get back into stocks a little bit. And so we'll talk about here, the small cap 600. And this is the index itself in the black. You can see the action here over a multi-year period, but in the blue you can see the forward price to earnings ratio. And what's really profound here is that particularly last year, and it continues this year, that the forward price to earnings ratio continues to drop like a rock. And we know we just saw where it's done that for the S&P 500 a few slides ago. But it continues a trend in small caps, and what's really interesting here is that the differential is actually pretty profound. I mean, on a relative basis, small caps are actually downright cheap right now. Quick look in here on the dollar. As I mentioned before, when you get in times of stress, there tends to be a flight to quality and dollar-denominated assets. And obviously, to get to those dollar-denominated assets, you have to add that there's an underlying demand for the dollar. We can see the dollar has moved higher. I think we're probably expecting the dollar to be a little less strong, perhaps, this year than it's proven to be. But you can see that the dollar on the right-hand side from BKA, that relative on a relative basis from fair value, that it really is overvalued right now, and that's just simply because we've got that strong flight to quality coming in these turbulent times. So Sentiment Trader produces this index, and I thought it was kind of interesting because it actually incorporates a lot of different things: economic data, interest rates, and a lot of other things go into this to produce this panic indicator. And you can see here, there have been times that that this thing has really spiked. Obviously, pandemic being one of them. Brexit, global financial crisis, Russian ruble default. This thing goes all the way back to 1955. And with all of the speculation about what's going on, in our markets with interest rates, with forwards and futures contracts and things like that, all of this increase in near-term volatility that we've seen kind of almost in a rush really hadn't moved this panic indicator yet. So, you can correlate a lot of these other periods of spikes that you see here on this chart with, they do correlate with recessions. And so obviously we had one, very short one with the pandemic, but we're just not near that right now. Here we've got pension funding status. This is actually a really bright spot. It doesn't really have much to do with anything unless you're with a company that has a defined benefit pension plan. But for years and years and years, we've talked about those plans being underfunded and a potential liability onto the state, or in this case, the federal government, the Pension Benefit Guaranty Corporation. But here we see that the funded ratio is right at 100%. And so that tells us that pension plans are really healthy right now and less of a potential stress or burden onto the overall market. All right, well, we'll talk about commodities now. And obviously there's been a lot written about commodities here lately, and for good reason, with the Ukrainian situation. Commodity spot index spiked. It was up 8.6% in the weekly change. You can see here on this diffusion index just how strong a move that was. I mean, commodities have really moved high, and fortunately we do have exposure to a basket of commodities. And you can see that it's fairly broad-based. On the right-hand side, you see wheat. You can imagine that Russia and Ukraine combined are a major source of global wheat, and then crude, obviously with the disruption of crude gas. The U.S. gasoline has been higher. We'll see a chart on that now, and that chart that I'm going to show you on gasoline is even a little bit dated. But corn, a lot of these things have moved higher. These are actually commodity returns, looking at it from an investor standpoint, but obviously if you're looking at it from a producer standpoint, and these are input costs into whatever you're doing, then it's a big deal. But the takeaway here is that the commodity basket spike is broad-based. It's not due to any one particular item. And here we have a couple of examples of what's going on. Now, the industrial metals, again, as it relates to production, manufacturing, home building, you see aluminum on the right-hand side. Both of them, look very similar in their tone and texture, and they're both moving higher. So this is obviously something that, creates a choke point for home buyers, and home prices moving higher, not just for the reasons of supply and demand, but actually for cost reasons as well. That home construction is going to bear the brunt of some of these increases for quite some time. And here's a quick chart on aluminum and copper inventories. And this is another driver behind high prices in the commodity basket right now. That in a lot of these cases, you're dealing with low inventories. Now, you look at, aluminum and I mean, these are global markets, and aluminum, there's a lot of aluminum that's produced in China. And you can see the trend line is already being established below the point that we were in last year, which itself was largely below the average over the last 5 years or so. Here we've got corn, same issue. Corn came off the high in the middle of last year and has now gone back up. And lumber, as it goes to home construction. Now, we looked at aluminum and industrial metals last time. Those had as much to do with auto manufacturing, durable goods, things like that. Obviously, corn goes into a lot of things, including ethanol. So there's that demand pull as well. Lumber, as you can imagine, has a strong influence on the home construction and non-residential to some degree. But you can see here, last year we were worried about prices moving to $1,200 1,000 board feet. Now, we've got the CME lumber punching through, 1,300 here. And a quick check-in on gold. Gold had traded in a range for some time, and now we do see it kind of catching a bit above 1900. And you can see this. I thought this was interesting because it does overlay the 100-day moving average for the S&P 500 volatility. That's in that red line. And you can see that there is a loosely positive relationship between volatility and gold. And so when things get a little volatile, you tend to see gold begin to catch a bid. Now, that's relationship doesn't always work out, but it is helpful to some degree. And you can see, with this latest spike in volatility that we're seeing that underlying bid in gold. Here we've got Brent prices, Brent crude, not too surprisingly, moving quite a bit higher here in a fairly short period of time because of tensions geopolitically. Right-hand side, we've got from the OIES, kind of a displacement issue because, we do import, a couple of 100,000 barrels of oil a day from Russia. And Russia's impact on the global market, if you take out, 4 million barrels a day of Russian oil production, or you make adjustments to it, you can see here, what that potential impact on Brent crude prices, has and could continue to be here, looking out over really the next several months. Here we have something I think is going to be a very interesting theme over the coming year. And I say year because it's going to take a while. In the black line, we've got rig counts. And we know that rig counts have been coming back up, but we know that in the pandemic, they were shut down and really struggled to gain momentum. So, there's pent-up production now with, prices that are approaching $100 a barrel on West Texas Intermediate crude. There's certainly much more of an incentive, and some of these drillers have now become financeable because the value proposition for lenders is much greater since you've got a higher commodity price, and the marginal cost of drilling in a lot of these areas is well below where current prices are. So, and where we are in prices is depicted in that blue line, and obviously well over $100 a barrel. Not that it's necessarily going to stay there, but what I think this is setting the stage for is a capital spending boom in energy. And I guess I still stick to my guns that by the time we get towards the end of the year, that we do see some disinflationary impacts in near-time inflation data from the impact of increased production. Now, it's also important to note that OPEC has less spare capacity than it did, but you can see here that rig counts are well below where they could be, and if prices remain high, I think you're going to see a tremendous supply response, which will bring those prices back down at some point. Here's gasoline prices. You can see the tremendous increase that we've seen, very inflationary and actually very near and dear to everyone's heart, because as I've said many times before, there's no better way to judge what's going on with the inflation basket than to kind of reflect on how much it costs you to fill up your car, and because you fill it up to a specific level every single time, and so it's easy to kind of see where that bill is going, and it's moving much higher. In fact, as I mentioned before, this chart is actually a bit dated. So now this comes to us on March 1, and I do believe that we saw a $4 print on average gasoline prices nationally here just this morning. Well, that will do it for the chart pack this week. Hope you've enjoyed it. On behalf of the entire team at BKA Wealth, hope you have a wonderful week, and we'll talk to you again soon. Take care.